everybody. Welcome to today's edition of the 1Million by 1Million podcast. I'm here today with Nilanjana Bhowmik, who has two affiliations. She has been a long-time general partner of Longworth Venture Partners and has recently co-founded a new fund called Converge. Nilanjana, welcome to the show.
Delighted to be here.
So let's get to know you and your venture capital associations. What is your background, and a little bit help our audience of entrepreneurs get to know you.
Absolutely, it's a great pleasure to be here, and let me start out with a little bit of my background and how I came to be in venture. So, I am an engineer by training. I have a undergrad and a master's in computer science, and I started my career at a very exciting company here in Boston called Object Design. This was the world's first object-oriented database, and backed by NEA and Harvard Management. Joined them as an engineer. The company was growing fast, raised my hand for every job that opened up, and quickly ended up running their entire solutions business. In the meantime, the company had gone public, and I ended up owning about a third of the company's revenue. So that was very exciting. But at the same time, I felt I could learn some more, and then got an MBA from INSEAD, and from there joined Broadview. For some of your audiences, they may remember Broadview. It is today the technology banking arm of Jefferies. Mm-hmm. And there I wore multiple hats. We not only ran transactions, but some of us who were technical enough also did equity research, if you will, but private company equity research. So I was in charge of running all the market maps that for enterprise tech that Broadview was very famous for. And that was quite an interesting experience because when you're in an operating company, you're like Object Design, your world view is very inside out. But if you're at a place like Broadview, where, which is dealing with M&A transactions of hundreds and hundreds of companies, you tend to take an outside-in view. And so I got to see how value gets created in a different way, financially. And I think that was very interesting training ground for what eventually became the third part of my career, which is venture investing. So from Broadview, I joined Longworth Venture Partners, and there I have been doing B2B early stage investing. And very recently got together with a longtime colleague, Maya Heyman, and launched a new venture firm called Converge. There is a very specific phenomena going on here in Boston where there is a huge, quality crop of very high-quality companies that are getting funded. There's quite a bit of seed capital here. But at the same time, the firms that used to historically do Series A, first institutional investing, if you will, have all moved to growth investing. So I guess they've become so successful that they have more and more capital under management. And as a result, there's a very big vacuum here for that foundational company building capital that used to be the role of Series A. So Maya and I see a big need for that type of capital to come back to this region. This region is very strong, particularly in B2B, given sort of our roots in, hard tech, the location of MIT next to us. So that's led to the creation of the new firm, and that's a very quick synopsis of my background and where I'm today.
Wonderful. So Longworth was about a $150 million fund, right?
It's the last fund was a $125 million fund, correct?
$125 million. And so talk to the stage that you want to invest in. How do you define Series A? Here in Silicon Valley, what we are seeing is a fragmentation and a segmentation of the seed to Series A ecosystem. When I was doing my first company, actually my second company was funded by NEA as well, but at the time NEA was okay with doing these very early stage deals, but they no longer are because they're so big. And your point about capital moving further and further upstream is very true. However, at least in Silicon Valley, there's a lot of new capital that has come in. A lot of new micro VCs have come into the ecosystem, and there's a ton of companies that are doing seed, post-seed, pre-Series A, small Series A. Even if the larger funds are going into the $7 to $10 million Series A, there is a class of funds that are coming in to fill the gap and investing the, 1, 3, 5 million Series A, gap that was created. So how do you define Series A from your point of view in the Boston ecosystem, and what do you want to see in the company, in a B2B company? What level of validation do you want to see to be able to call that company worthy of a Series A from your standpoint?
It's a great question, and I think the market is extremely confusing, but at the same time, I would also say that I think there's a rich array of choices for entrepreneurs. But someone starting a company today needs to understand the nuances of these terms and funds and dynamics more than before, so that they don't waste their time with the wrong firm. So Series A for me is a type of investing. So meaning that Series A tends to be a particular type of portfolio construction where ownership matters, which is very different from seed investing, where you're spreading your capital across a much larger number of investments and you're compromising on ownership. So, what I would say we do is classic Series A investing, meaning we construct a smaller portfolio. We still have enough number of companies in those to have diversity for our investors, but we take significant ownership, and that's the key. The stage of the company can vary. It can be, two entrepreneurs with no company formed yet, all the way to a company that has raised some capital and has some revenue. So that's sort of the difference. So, for example, in my Longworth portfolio, I have companies where I have been the very first foundational investor, if you will, where there was sort of no product, no office. And sometimes we call the security a Series Seed. Sometimes we called it a Series A. But it was comprised of one or two investors that took some meaningful ownership and therefore had skin in the game to stay with the company through its growth. So it's how you reserve capital and how you think about follow-on investing. That's really the key difference in what might be called a Series A investor versus a seed investor.
Well explained. So you are, if I'm hearing you right, you are comfortable with, a team that has a concept and is pre-product? Your definition of Series A embraces that kind of a team? Is that a reasonable observation?
We may call it security, maybe call a Series Seed. And really it depends on where in the tech stack that company is and what's the profile of the team. So typically, we invest up and down the tech stack. By the tech stack, I mean sort of, very high IP infrastructure layer all the way to sort of easier to get started with a couple of million of seed application layer. So if it's at the application layer, it's relatively easy to start something with $1 million or $2 million of seed capital and get to, some revenue. But we see companies that have taken $1.5 million of seed and are getting to $1 million of ARR. So for those types of companies, we will go in after the seed round, and we will, because there's such a huge supply, we are more demanding, and we will look for some revenue and early momentum. On the other hand, if it's a company which is sort of, hard IP that requires some significant engineering dollars before revenue can be seen, we are very comfortable going in pre-revenue, pre-product.
Excellent. Very good to hear that, because it's such a rare category these days, what we call slightly, doesn't really follow the lean startup principle. It's a bit of a fast startup, and I know a few investors who do those things, but there are not that many, and it's good that you're doing that as well. So within B2B, what trends do you see? Like if you look at your last, let's say, 15 months of deal flow, what are you seeing and what are you liking?
We see a lot of things. We focus on a few things. So we are in the class of more proactive investors. So we are quite disciplined in the type of things that we want to go after. And I can mention a couple of areas that are of interest in our current fund. One area which is emerging, which is extremely early, and you could say, 98% of it is noise, but 2% is quite real, is blockchain. And within that specifically, we are interested in the protocol versus, currency related technology. So that's an area that's of great interest. There's a huge, surprisingly very high quality company formation taking place, and surprisingly customer adoption has begun. So it's not that early. We see that as a huge. It's a protocol that has the potential to displace the entire software stack. So it's of great interest to us. But it's early days. Another area where Boston is very strong and where we see a huge market opportunity is what we call Industry 4.0. We think that the technologies are at a certain set of technologies are at a point of confluence, which is bringing about sort of the biggest change to manufacturing since the Industrial Revolution, and so. That would be the confluence of robotics, advanced robotics, IoT, AI, additive manufacturing. We have invested in all pockets of those areas, but we are becoming quite systematic in our approach to the transformation.
And MIT is full of those.
and MIT is, a lot of robotics additive is coming out of MIT, and so that's exciting for us.
So do you invest only in the Boston area?
We invest up and down the East Coast, and, the big tech hubs on this side are obviously Boston, New York, and, surprisingly high quality of companies now coming out of Canada. Toronto and Ottawa. Waterloo obviously has been a strong computer science school, and so we see good activity there as well.
Great. What are the highlights of your current portfolio? And this probably we're talking about Longworth as opposed to Converge, right?
Right.
Yeah.
Yeah, these are, I'd say a good range of companies spanning all the way from infrastructure to the application layer. We just transacted a company in the crowd-sourced application testing area that we first backed way back in 2009-10, and this was called Applause. And what they did is they created this whole concept of on-demand testing of software. So truly leveraging the power of the cloud to not have to have sort of your entire own infrastructure of testers and Q&A professionals, but really getting it done on demand on as-needed basis. Again, great example of a company where we were the first institutional investor, and we took that all the way to 100 million plus in revenue, and the company was considering going public, but got a strong inbound offer and decided to exit that way. So that was a recent good exit for us.
Excellent.
And then
great.
And we have several other very exciting companies. I mentioned additive manufacturing. We have a company called Rise Technologies, which is a breakthrough innovation in additive and 3D printing, where it brings the strength of metal to thermoplastic parts, and it eliminates all post-processing, which has been a huge impediment to adoption in 3D printing over the past 20 years. So that's another exciting company where you can bring 3D printing to the point of manufacturing, where it needs to get where a part needs to get manufactured and consumed. That's an exciting one. There are many others, so we love our portfolio like our children, so we can keep talking.
Of course. And what percentage of your deals are MIT origin deals?
I would say, MIT origin or MIT staffed would be almost half of it, probably.
Well, as you can imagine, I have a huge soft corner for all that.
Your alma mater, correct. Yes.
My alma mater, absolutely, yes. All right, well, very good. It's gives me an idea about what you're doing and where you're focusing. Well, I'll ask you one last question.
Sure.
Actually, two last questions, and both of those are trend questions. One of them is about unicorn mania. Silicon Valley went kind of bonkers with that unicorn mania, funding all sorts of stuff with all sorts of bad terms, over-bloated, overfunding, death by overfunding, all kinds of nonsense. How do you view that sitting in Boston? How does unicorn mania feature in your world, in your universe, and how do you parse it?
Yes, I think we are blessed that we are removed from Silicon Valley by a few thousand miles. So, and the fact that we do B2B. So I think, I think the unicorn mania is a combination of it's concentrated more in the Valley and more in consumer tech companies. I think which have a very different profile. So we tend to see far less of that in the B2B world. I think in the B2B world, things tend to be a lot more metrics-based, and therefore valuations are grounded in operating performance, if I may say so. So, I think we tend to really focus on company building, strong operating metrics once we go into a company, and then, the growth. Investors respond accordingly. If a company is operating well and it has strong metrics, then there's a lot of capital upstream that wants to come into those high-quality companies. But we always keep our expectations, and we tell our management to keep their expectations real, because too much money at too crazy valuations can sometimes end up being a problem for business. So
huge
good
problem.
business.
Can be a huge problem.
Right. So, expectations, if they're distorted, can lead to just sort of a good situation appearing to be not so good, because your expectations are there's just too much demand on management to produce results that a company simply can't. And that's right. So that's a problem sometimes with unicorns.
Yeah. So last question. We are in March 2018. And, lots of stuff has already been built. There aren't as many wide open billion-dollar opportunities out there, but there are many niche opportunities. And some of these businesses need to be built for smaller amounts of capital and sold for, early exits, smaller exits. The vast majority of the exits in our industry happens at the sub 50 million range. So if you do stuff for, in a capital efficient manner, you can access these reasonable exits, and there are just a lot more such opportunities than the big billion-dollar swinging for the fences kinds of opportunities. How do you view these? How do you view this dynamic of the industry?
I absolutely, agree with that. I mean, I have this conversation with many entrepreneurs that not every business needs or should raise venture capital. I think, and then, I think entrepreneurs really need to understand that. And sometimes they don't have to make that decision on day one, right? They can start with some seed capital and see what type of business it is, what growth it can possibly have. And frankly, what's the best decision for the entrepreneur? I mean, sometimes taking money kind of robs you of a good exit opportunity because the venture investors have a different expectation in terms of outcome. So I 100% agree with you. The good news is I think there's that the possibility for that set of exits between 10 to 50 has increased in the last 5-10 years, right? So I think entrepreneurs need to be smart about capitalizing their business and keeping their options open.
Yep. All right. Well, wonderful. Nilanjana, please let us know if you are visiting the Bay Area, and let's get together in person.
Absolutely. Thank you for your time, and great pleasure talking to you.
Yeah, likewise. And thank you, audience, for listening. Be sure to check out the website and go to 1MBY1M.com and go to the free public roundtable tab on the top of the homepage. There you will find the schedule for our free mentoring roundtables. If you want to bring your project and work with us in a safe working environment, get some help, get some coaching, get some mentoring, you're most welcome. And I will see you soon at either one of our next mentoring sessions or one of these podcasts. Speak soon. Bye-bye.